A flower did not ruin the Dutch economy in 1637. People did. That's the uncomfortable truth we tend to smooth over. We like the image of tulips as the villain, bright petals, absurd prices, a collective lapse in sanity. It feels safer to blame a plant than to admit that the same wiring still runs through us, the same instincts, the same stories we tell ourselves when prices go up faster than reason. Because for a brief moment in the 1630s, in the wealthiest, most financially sophisticated society on Earth, a single tulip bulb could cost more than a house on one of Amsterdam's best canals. Not a rare gemstone, not land, a bulb, something that could rot in the ground. And what makes this story uncomfortable isn't how strange it was. It's how familiar it feels. To understand why Tulip Mania still matters, you have to understand the world it happened in. The Dutch Republic wasn't some medieval backwater stumbling blindly into speculation. This was the cutting edge of capitalism. Global trade routes, the world's first stock exchange, sophisticated contracts, futures markets, options, leverage. They had joint stock companies when most of Europe still ran on feudal habits. In other words, if a bubble could happen there, it could happen anywhere. Tulips arrived in the Netherlands from the Ottoman Empire in the late 1500s. At first, they were just another exotic import. Pretty, unusual, a status symbol for wealthy collectors. But then something subtle happened. Tulips began to mutate. Certain bulbs developed streaks of color, flames of white cutting through deep reds and purples. These broken tulips were rare, unpredictable, and impossible to reliably reproduce. No one knew it at the time, but the patterns were caused by a virus that weakened the bulb even as it made it more beautiful. Scarcity plus beauty is a powerful mix. Collectors began competing, prices rose slowly at first, then faster. And as prices rose, the story around tulips began to change. They stopped being flowers. They became assets. By the 1630s, tulip trading had spilled far beyond botanists and aristocrats. Merchants, craftsmen, brewers, even chimney sweeps were involved. But here's the detail that often gets skipped. Most of these people never touched a tulip. Tulips bloom in spring, but trading happened year-round. So instead of exchanging bulbs, people traded contracts, promises to buy or sell a bulb at a future date at a fixed price. These contracts changed hands dozens of times before a bulb ever came out of the ground. This is where the mania stopped being about flowers and started being about math. If you could control a valuable asset with only a small upfront commitment, you didn't need wealth to speculate. You needed confidence, or optimism, or a belief that someone else would pay more tomorrow. The contracts were often informal, written on scraps of paper, enforced socially, not legally. Deals were struck in taverns after a few beers, sealed with a handshake and a chalk mark on a board. This wasn't chaos. It was trust. And trust works beautifully, until it doesn't. As prices climbed, stories multiplied. A single bulb sold for the equivalent of 10 years' wages. Another for a small fleet of ships worth of goods. These weren't exaggerations. Records survive. Real transactions, real money, real livelihoods concentrated into something that could be crushed under a boot. But the most important thing wasn't the prices. It was the logic people used to justify them. Tulips weren't expensive because they were useful. They were expensive because they were expensive. Because demand was growing. Because the market was discovering their true value. Because this time was different. There's a moment in every bubble where skepticism becomes socially unacceptable. Questioning the price doesn't make you cautious. It makes you old-fashioned, or bitter, or too stupid to understand what's happening. In the Netherlands, that moment arrived around 1636. Trading volumes exploded. New buyers entered purely to flip contracts, not to grow flowers. People borrowed to speculate. They sold productive assets to buy paper claims on bulbs still buried in frozen ground, and then, quietly, without drama, it stopped. In February of 1637, at a routine auction in Haarlem, buyers failed to show up. No panic, no riot, just hesitation. Prices stalled, then dipped, and suddenly every assumption collapsed at once. If prices could go down, why buy today? If tomorrow might be cheaper, why commit now? Confidence vanished faster than it had formed. Contracts that once changed hands effortlessly were suddenly unwanted. Buyers refused to honor deals. Sellers discovered their wealth existed only on paper. The informal nature of the market, which had allowed it to grow so fast, now made it impossible to enforce. Within weeks, prices fell by 90% or more. The damage wasn't evenly distributed, the Dutch economy didn't collapse. Trade continued, ships sailed. The myth of national ruin is exaggerated. But at the individual level, the losses were devastating. Fortunes evaporated, reputations were destroyed, lawsuits clogged courts, friendships ended. And after it was over, something interesting happened. Everyone agreed it had been obvious in hindsight. Tulip Mania became a moral lesson, a joke, proof of human irrationality, a historical curiosity safely boxed off in the 17th century. We tell the story as if it's about ignorance, or greed, or a lack of modern regulation, but the people inside it didn't feel foolish. They felt smart. Early adopters had made money. The system rewarded belief right up until it didn't. And by the time disbelief became rational, it was too late. Here's the part most retellings skip. Nothing structurally unique caused Tulip Mania. No exotic psychology, no mass delusion gene, just leverage, narrative, and the human tendency to extrapolate recent trends into the infinite future. Which raises an awkward question. If the most advanced financial society of its time could convince itself that a flower was worth more than a home, what kinds of assets might we be overvaluing today? Not because of what they produce, but because of what we believe they represent. Because the language surrounding tulips in the 1630s, scarcity, inevitability, revolutionary value, sounds uncomfortably similar to conversations happening right now. Because once you strip away the petals and the powdered wigs, Tulip Mania isn't really about history, it's about pattern recognition, and whether we're actually better at it than our ancestors, or just better at hiding our mistakes behind new vocabulary. Take a step back and look at what was really being traded in 1636. Not flowers, not beauty, expectations. Future demand pulled into the present and priced as if it were guaranteed. The bulb itself was almost irrelevant. It was the story attached to it that carried the value. That should sound familiar. In every modern speculative cycle, the asset is framed as a portal to the future. Railroads, radio, dot-coms, real estate, crypto, AI. The pitch is never, this is overvalued, but you can flip it. The pitch is always, you don't understand how big this is yet. Tulips were scarce. Crypto is scarce. Tulips couldn't be easily replicated. Neither can a particular blockchain. Tulips had unique patterns. NFTs had unique hashes. Different century. Same structure. What changes is the costume, not the script. In Tulip Mania, leverage didn't come from banks. It came from contracts and social enforcement. Today, leverage is cleaner, faster, and far more powerful. Options, futures, perpetual swaps, margin accounts that liquidate you in milliseconds. But the psychological effect is identical. Small amounts of capital controlling large amounts of exposure. When prices rise, leverage feels like intelligence. When prices fall, it feels like betrayal. Look closely at how modern bubbles justify themselves and you'll notice something subtle. Utility is always just over the horizon. Crypto will replace money. AI will replace labor. This network will replace that institution. The value today is based not on what exists, but on what must exist for the price to make sense. Tulip buyers didn't need flowers to bloom. They needed someone else to believe. And belief scales faster than production ever could. This is why bubbles tend to peak when the story becomes most sophisticated. Early narratives are simple. This is rare. Later narratives are complex. White papers, economic models, long threads explaining why traditional valuation no longer applies. Complexity doesn't reduce risk. It camouflages it. During Tulip Mania, the rarest bulbs were given elaborate names, genealogies, reputations. Prices diverged wildly based on perceived prestige, not fundamentals. Sound familiar? In Cryptos, a meme coin with no revenue can outperform a functioning company because its narrative travels faster. In AI, a startup with no product can raise at extraordinary valuations because it's adjacent to the right buzzwords. Capital isn't chasing output, it's chasing optionality. The possibility that this might be the thing everyone else wishes they bought earlier, and here's where the danger really lies. Bubbles don't collapse because people stop believing in the long-term story. They collapse because the short-term mechanics break. Liquidity dries up. Margins get called. Buyers disappear for just long enough to trigger doubt. That's exactly what happened in February 1637. No bad news. No revelation that tulips were useless. Just a failed auction. A pause. In modern markets, pauses are even more dangerous. Algorithms don't hesitate. They execute. They amplify momentum in both directions. A dip becomes a cascade. A narrative flips from inevitable to obvious fraud almost overnight. And then comes the rewriting of history. After Tulip Mania collapsed, the Dutch passed laws to retroactively soften contract enforcement. Losses were reclassified. The system absorbed the shock. Life went on. But socially, the blame shifted. Speculators were mocked. The mania was framed as madness rather than misaligned incentives. That reframing serves a purpose. It protects the idea that we are rational now. But are we? If you listen carefully, modern financial culture still celebrates the same behaviors. Early risk-takers are geniuses. Late entrants are fools. Survivorship bias gets mistaken for skill. Entire industries are built on telling convincing stories slightly before everyone else hears them. And the most uncomfortable similarity of all is this. During Tulip Mania, many participants knew it was absurd. They joked about it, they mocked it, and they bought anyway. Because as long as prices were rising, skepticism felt expensive. This is where comparisons to AI and crypto become less about prediction and more about posture. This isn't an argument that these technologies are worthless. Tulips weren't worthless either. They're still grown today. They're still beautiful. The question is whether price has drifted away from use, and whether belief has outrun reality. AI will change the world. That can be true. It does not automatically mean every AI-related asset is fairly priced. Crypto introduced real innovations. That does not mean every token represents lasting value. Tulip bulbs could be stunning. That did not mean they were worth a lifetime of labor. Markets have a way of confusing possibility with inevitability. And here's the part most people miss. Bubbles don't require everyone to believe. They only require enough belief at the margin to push prices higher. As long as someone is willing to pay more tomorrow, the system feeds itself. Until it doesn't. When belief breaks, it rarely breaks cleanly. It fractures. Some narratives survive, others quietly disappear. A few winners emerge, usually indistinguishable from luck. And the majority of participants are left holding something that made sense emotionally, socially, and intellectually, right up until the moment it didn't. Tulip Mania isn't a warning against innovation. It's a warning about timing, leverage, and stories that become so compelling they stop being questioned. And the most unsettling part of the story is not that people once traded houses for flowers. It's that, given the right conditions, we would probably do it again, confident that this time we're being rational. So the real question isn't whether today's markets resemble 1637. It's whether we'd even recognize the moment when they do.